Hey everyone, welcome to this short video, part of our hedge fund series. This is talking about merger arbitrage. It's a type of hedge fund investment strategy and it's one of the most common, and like I said, it forms part of our hedge fund video series. You can find the other types of strategies that you might find in a hedge fund and a video of them on the Rask Finance website. So we're talking about merger arbitrage. What is it? Well, merger arbitrage, as the name suggests, is focusing on merger transactions. So this is when one company merges with another company, and they typically do so because they want to grow or there's some strategic rationale behind it. But it's not just, this is where the name can be a bit misleading. It's not just mergers. Mergers when two companies come together. It can also be takeovers. So when one company, say a bigger company, announces a takeover of a much smaller company, they can do this. And the arbitrage component of the name suggests that you're taking advantage of two different prices. So you've got one price and you've got another, you're taking advantage of the gap between the two. That sounds really confusing? Let's use an example. Let's say we have a company that is trading at 80 cents per share before a deal or an announcement or a merger is announced or anything like that. So we've got this company, it's trading for 80 cents, then a deal is announced. And the offer for the deal is $1.25. So let's say a big company comes along and says, I'm going to take this company out, I want to buy it. We're willing to pay $1.25 per share. And that might be in 3 months' time. They say, once we've got all the legal stuff sorted out, we've got approval from everyone, we'll pay all shareholders $1.25 per share. Now, what typically happens is after the deal is announced, the share price will jump. So let's say the share price is 80 cents today, a deal is announced, the shares are no longer trading for the rest of today, so when they come back to trading tomorrow, the share price jumps to $1. Now normally it would be, depending, this is where it's, where the finer details are important, depending on the deal, depending on the offer made and the conditions associated with that and who the offer is coming from. If it's a very reputable, I suppose, acquirer, so it's a big company, they've got a good track record of getting deals done, then this share price might be closer to the offer price. But let's say for round figures that the share price jumps 20 cents or about 25% from 80 cents to $1, and you have the opportunity to buy those shares at $1 on the market. Now, what you can clearly see here, that if the offer goes through and this company does in fact acquire this business, then you're going to make 25 cents for every dollar that you invest, or for every share that you own for $1, you're going to make a 25-cent return, or 25% in this case. So if you can get a 25% return in 3 months, let's just say the offer is in for 3 months, that's a pretty good return. For 3 months, a 25% return, you know, I say almost anyone would take that. But, okay, so why would this type of thing happen? Well, the reason why it doesn't trade perfectly at $1.25 is due to the conditions and the risk associated with the deal. So oftentimes you'll find that a company goes, I'm going to acquire that other company for $1.25, but here's 10 pages of conditions. Now, that's a bit dramatic, but you'll often find that there'll be a number of conditions within that offer. And those conditions create uncertainty. So that might be shareholder approval, it could be regulator approval, it could be they need to get debt financing, so the bank needs to approve them for a loan to buy the company. There are so many uncertainties that need to be, I suppose, overcome before the deal can proceed. And that also includes the company that is being acquired. They need to get board approval and the board needs to recommend it. So there could be shareholders in that company that own a large stake or a blocking stake that might reject the offer. So, but from an individual's perspective, from a small shareholder or small investor's perspective, you can, what we call arbitrage, you can make the difference in price between these two. So you can potentially exploit this 25 cents per share if it goes through. Now, it doesn't always go through. Sometimes deals fail. One of the conditions might not be met, or just there's some other risk that no one saw and something went wrong. So what happens is the share price might fall back to what it was before the offer was made. Now, if you're buying at $1 per share and it fails, you're obviously losing 20 cents per share. So you're in fact, that's not a very good trade, if you like. Sometimes it might not fall back to 80 cents, sometimes it might fall lower, sometimes it might stay a bit above 80 cents. There's really no way to know for sure, but you know that it's going to be trading for less than if the deal went through. So you can see already that there's some benefits to this. You can potentially make a profit. It's a shorter term type of investment, but there's another thing that's really important to understand, and that is if this is a 3-month deal, let's say in an ordinary share market, and I'll just draw a very basic chart here. Let's say in an ordinary share market, prices are bouncing around like this, right? In 3 months, you don't know where it's going to go. But if you know for certain that you're going to get an offer for your shares at $1.25 3 months in the future, they might look like this. So you know in 3 months that you're going to get an offer for $1.25 and you can sell your shares. So what you'll find is that companies that are under a takeover offer, their share prices are less volatile, so there's less bumping around. So if the market's bouncing like this, the share price of this company might go something like that. And it's just a line, a slightly sloping line that just hits that $1.25 in around about 3 months. And the reason that happens is because people believe that as that date gets closer to $1.25, the risk associated or the uncertainty with all the conditions and everything that comes with that get smaller and smaller and smaller. But also investors need less and less and less to get the return that they want from investing in this opportunity. So what we call this, and this is a fun finance term that you've probably heard before, is correlation. And that's how, all that means is how two things relate to each other and whether they're bouncing around a lot, and this is obviously based on historical data, whether they've bounced around a lot or they move it together. As you can see here, if you've got a share price that moves like that, just a nice little line, and you've got one, and the market's bouncing around like that, we would say that the correlation is low. So there's a low correlation to the market. Now that's too much finance jargon for one video, but you can see here that there are risks, and oftentimes, these documents, the takeover documents are quite lengthy and full of conditions, and you need a lawyer to decipher them, it seems. So there are risks. Some people say this type of strategy is like picking up pennies in front of a steamroller, because you get oftentimes a very small return, but if you get it wrong, the risk can be quite severe. So that's merger arbitrage. If you have any questions, be sure to find our Contact Us page on the Rask Finance website and fire away.